Hi, and welcome to the CostofCarry podcast. My name is James Chi. Let's get into it. Your job can affect what type of loan you can get or are eligible for. In the instance of getting a residential mortgage, the way that your job affects what loan you are eligible for relates to both your PAYG or self-employed status and the type of industry that you work in. For example, if you are a PAYG applicant, your ability to get a low or alternative documentation loan whereby you don't use your full financials is difficult and limited. And there isn't really a reason why, if you are a PAYG applicant, that you wouldn't have your tax return completed compared to, in comparison to a self-employed applicant who may have both their financials and their business tax returns available. And the benefit to this is that the self-employed applicant can also access the low documentation or low and alternative documentation option, which allows either the choice of an accountant's letter, 1 period's worth of financials, or 2 periods worth of BAS and bank statements. So a combination of those 4 may satisfy a lender giving you a loan other than using your full documentation. And the reason why a applicant may want to use a alternative or low documentation path is because there may be variations that aren't fully represented in the figures on the page. And so what this allows the applicant and broker to do is provide the supporting documentation that accurately reflects the situation that the borrower is in. So, for example, if, say, your business is in a startup and in the first year you didn't generate a lot of revenue, however, in the second year of business you generated a high turnover, and so what this allows is on your application for you to show the difference and the reasons why your application should be assessed on the most current year's financial figure. And in addition to that, if you work in an industry that has been red flagged or ring fenced, so to speak, this can also affect your loan. And types of industries and jobs that can fall into those categories are anything that has to do with sins of the flesh, as well as environmental type of jobs that are not permanent or fit within a traditional contract, or relate to something that has ties to a law enforcement matter. So what those means is that, say you own a brothel or a pub, this can be an issue. If you own a service station, this can be a slight issue as well. If you work in the mining industry, this can be somewhat of an issue because of the stance that some lenders who have an environmental sustainability policy as well. And if you're involved in an industry that comes into possession of possibly stolen goods as pawnbrokers, this can be an issue as well. And that isn't to say that the person who's applying for the loan is the issue. It's just that when you assess the loan and the way that they put each borrower into a bracket, and if you use the demographics and statistics available and you fall within something that they don't feel comfortable with, that's the main reason why you wouldn't be eligible for a certain type of loan. So it's a really important thing to understand from the outset, because if a person who's looking for a loan wants to go direct to the bank may or may not look into these at the outset. However, if you go and see a broker, the broker will do enough of a fact find to understand what your profile is, so to speak, so that they can adjust their search to find you the most appropriate product. What is the difference between prime and near prime lending? The reason why near prime lending is growing is for the same reason that I mentioned why the low and alternative documentation loan options are available. And it's that In some instances, borrowers feel as though it is more appropriate to pay a higher rate for a near-prime loan facility than it is to provide the full documentation and pay a cheaper rate but not be able to borrow as much money. If, for example, you require a loan product that requires X amount of servicing on your behalf, but the figures in the financial returns in the 2 years leading up to you getting the loan don't stack up, then this can be an issue. And if you can show in the most recent year that servicing can be achieved for the amount of financing that you need, given the higher rate, and the supporting documentation fits the assessment criteria, then this could potentially be something that is more appropriate for your needs than it is to providing all the full doc requirements. This is the difference between a prime and a near prime. Prime is full doc in the box, not much risk, not much uncertainty, whereas the near prime is nearly the opposite. There's more risk, there's a little bit less certainty, there's a little bit more flexibility in the solution provided. And I think this is important because for those who do manage their own affairs through their own business, it's easy to understand why this near prime solution is so popular and works so well, and it's because being a business owner is unpredictable. There's no static or fixed way of doing business. Some months are really good, some months are really bad, and the only thing that's certain is that each day is going to be different. That's the only certainty. And so what the near prime option allows is for these types of borrowers to access funds that they typically weren't able to access before. The difference between going direct to your bank and lender and letting a broker look for you. Tying in the first 2 points of this podcast, the reason why you would see a broker, or why going to a broker is different than going direct to your bank, is because in these trickier situations, the broker is able to sell the story. Not only does the broker look for the best product in the market that suits your needs compared to the bank, which can only provide the solutions that they offer, but the broker is also there to navigate the intricacies of the situation. So the broker can convince the lender why the application and the client is worth taking on. This can't always be done with the bank and lender because there's so many moving parts in the organization that it's hard to analyze in detail what's going on with the applicants, whereas the broker can sit down and fill out the application, fill out the file notes, understand the reasoning behind and the purpose for getting the loan. And this is what helps the broker and gives them an advantage over the banks and the lenders, in that the brokers are there to provide the options to their clients that would otherwise be unavailable. And the reason for that is also because some lenders and banks don't deal with clients, they only deal with brokers. If the applicant would want to go direct to the bank, they would be missing out on some of the deals and products that are also available out there. What to look for in a broker. So as I just mentioned, the advantage of going with a broker over going direct to your bank and lender is that the broker can assess all the options on the market that are available to the public and brokers, rather than just looking at just what's offered to the market. And so what people should be looking for in their broker is the qualities of professionalism, timeliness, knowledge, insight, respect, understanding, a little bit of charisma, and someone who is disciplined, determined, and ambitious. And look, that may be too big a shopping list to ask for in a broker. However, the reason why these qualities matter is that it becomes a matter of preference to what the client wants. And some clients aren't always looking for brokers who are communicative or charismatic or too disciplined. However, they will always be looking for a broker who will be timely, professional, respectful, insightful. And I think this is something that You can only pick up through conversation and through interaction and engagement. Sure, you can read a profile summary on LinkedIn or the brokerage or broker website or social media page. Finding a broker who can deliver on what's required can be a challenge, and this sometimes isn't apparent until after the loan has settled. And what happens is there can be some so-called hidden surprises in the loan, whereby there are fees have been charged, or the loan is in the wrong structure, or that there has been a lack of compliance in the process. It really depends on how the customer perceives the broker from that first interaction. And so that really matters on presentation, on the broker's presentation, and on the broker's level of engagement in your scenario. And on that note, that concludes this episode of the Cost of Carry podcast. I hope you all enjoyed it, and I look forward to speaking to you in the next episode.